Hello, I'm Dave Brinkman, partner in our wealth management practice, and I'm joined by two of our younger advisors in the practice, Sean McCann and Matt Biggs. Recently, there was a Wall Street Journal article published titled, Rich Millennials to Financial Advisors. Thanks for the golf invite, but you can't invest my money. And obviously, we wanted to respond with some additional thoughts on the article, kind of some of the points that the article makes, and really just kind of give our response, if you will. So, Sean, in the article, there's some Federal Reserve data that was looked at that said, look, 70% of households with $500,000 or more of assets, and let's say the household is mid-40s and below, basically was managing their own money and managing it in a fairly aggressive manner. Maybe, I'd like to bring you into the conversation here, and one of the points we make in the article is, in our opinion, recent capital market performance is likely having an impact there.
Sure, Dave. As you said, these individual investors who are being very aggressive or taking a lot of risk, whether that be using options contracts or maybe going all in on the S&P 500 or investing in cryptocurrencies, which, perhaps they don't have a full understanding of, or perhaps they've just heard it on social media. And they've been rewarded for taking that risk and for being aggressive. The S&P 500 is up over 100% since the lows of the COVID-19 pandemic, and the price of Bitcoin is up over 750%, which is a tremendous return to get over the 12-month or 15-month period. And so if individual investors take those returns and compare it to what they believe they can get in we'll call it a 60-40, or maybe the returns they can get with an financial advisor, I think that individual investors are going to be quite confident in their ability to generate these returns and to keep these returns going forward, considering, all they've known over the past 12 months or so is a rising market that kind of goes up and to the right, almost, we'll call it actually over every other day.
Yeah. I love the Jason Staley reference there, up and to the right. He's trademarked that, in my opinion. So, Matt, let's compare kind of what Sean was alluding to, which is arguably the last, year and a half, COVID lows last March, to the Dalbar study, which, just for the benefit of the audience, is a study that tries to come up with what is the average rate of return for an individual investor, looking at, mutual fund sales and redemptions on a month-to-month basis. So, Matt, maybe, and we included the Dalbar study's research, give the audience a little bit more on that.
Yeah, so you mentioned it, Dave. The Dalbar, all it does, it looks at various indices, how they performed from 2001 through 2020, and it compares it to the average investor. So they get that average investor return from looking at mutual funds redemptions, and that return is 2.9%. Sean was just mentioning how well the S&P has done, and the Dalbar study, it's up 7.5% in that time frame. Now that's without dividend reinvestment, but the 2.9% compared to the 7.5%, obviously there's a big gap there, right? Well, what would the reason for that be? So that's where we would say as advisors, most individuals kind of self-managing, emotion kicks in, right? So let's say you've got $500,000 and COVID happens, right? And we see markets sell off 35%. So your $500,000 drops down to $350,000. That becomes pretty emotional, right? That's your life savings right there. And you just saw it chopped down by $150,000. What we tend to see, and what the Dalbar study really proves, is investors get emotional. They want to stop the bleeding, and they end up selling right at the exact wrong time. Whereas if you would have wrote it out, you would have experienced the returns that Sean mentioned in that time frame. So that's why we would advocate for working with an advisor who can help you keep your emotions in line and maybe take that emotion out of it for you.
Yeah, and to the chart that we put in the article, you don't earn 110% in the S&P 500 unless you held your wit in March of 2020 and either stayed invested or even leaned into it if you really wanted to be an aggressive investor. I think that's the other thing that sometimes is underappreciated. It always looks nice in hindsight to say Bitcoin's up 750%. You're just going to have to live through some pretty harrowing drops. I mean, I think we saw a 20% drop here in the last couple weeks. So we were very intentional in trying to seek out Matt and Sean in writing a response to this, obviously given the age and kind of more or less talking to their generation, if you will. One of the things that we also went a little bit deeper on in the article is, comparatively speaking, when you look at the millennials, their financial landscape is fairly complicated. Arguably, they have higher debt burdens than previous generations. They're living at home with mom and dad a little bit longer for various reasons. And, to the extent that they are getting married and having kids or, raising a family, they're generally doing that later than previous generations. So Matt and Sean, I guess I'd like you to, provide your perspective to the audience around some of these generational stats, and then ultimately, how does that kind of play in when we think about, do millennials really value a financial advisor?
Sure. As somebody who is, younger to mid-20s, who experiences a lot of the same characteristics that you just mentioned, student loans, not owning, your own house, not married, I could understand where the average investor, really wants to invest or get high returns from cryptocurrency or trying to, use options to generate high returns. But, as somebody who I feel is fortunate enough to have a financial background or who has some relative knowledge of wealth management, I understand the effect of compounding. I understand that the decisions I make today will impact me in 25, 30 years. And so I really wish that this video and this article can show to our millennial investors out there that what you decide to do today with your money, whether that be paying down debt or investing, really does have a greater impact on you when you go down the line.
Yeah, Sean. So I would say the back half of this article, I'm basically a walking example of, right? So graduate college, got a little bit of student debt under my belt, go back, live with the parents for 6 months, try to pay some of it off as fast as I can. Got married in my late 20s, started the family when I was 30. So it's very common. And most of my friends, in their 30s now are just now getting married and starting families. So I think the parallel is, right, to the article, we're still in the front nine of this. So, if we're playing 18 rounds, I'm still in the front nine. And as life goes on, as things get more complex, as my family grows, as my friends' families grow, that's when you need help with an advisor. As all of these things are happening, it takes a lot of time. You may have the knowledge. Most people do. Most people we work with are very, very bright individuals. And they've got the knowledge that they could do this themselves, but they don't have the time because this isn't a 1 hour a week job that you can manage your portfolio, do all the planning, do all the tax planning, and be okay. So once we start to see people enter the so to call it the back nine of their lives, that's when we see people more and more open to working with an advisor because they really need the help at that point.
Right, and that was our final point at the tail end of this article. As the income, the assets, family, just the complexity of life expands. Historically speaking, other generations have found the value in having a financial advisor or, a golf caddy, if you will, that we played up in the article. And I think our general opinion is we don't see that changing. It just may be a little bit later in life relative to other generations. So Sean, I think our last point here, and at the very end of the article, we make this point. There's that stat out there for lottery winners, but maybe for the audience's benefit, maybe articulate on that.
Right. So I believe the last stat in our article was that over, 70% of people who either win the lottery, somehow get into a large sum of money, they end up losing it, whether that be in a couple years or, maybe a little bit longer than that. But, it is very common, and we do see that from time to time. And I'd really put that down to the fact that, managing your money or wealth management as a whole has a lot more to do than just picking stocks or picking bonds or picking your mutual fund. It's a combination of a couple of different things, whether that be estate planning or tax advice.
That's where an advisor can step in and help you be intelligent with that money and make sure that it's going to last throughout your lifetime.
Well, gentlemen, thank you for joining me today to kind of give the audience a little bit more. And obviously, thank you for putting your thoughts down and responding to the article.